Good afternoon. I'm Brent from Quantum Advisory. We're a accounting firm that specialise in small and medium family businesses, and we assist them to gain control, grow profits and reduce tax. This afternoon we wanted to run through budgeting and what successful budgeting looks like. And with me I've got Alistair, one of the senior partners here. So we're going to just run through a quick agenda of what we've got in mind and run through some practical examples and run through any questions at the end. So keep a pen handy or submit them via the chat box and we'll address them. So when it comes to budgeting, first of all, we're just going to run through why we need a budget. So why it's important, and then we're going to just have a quick look at what the fundamentals of budgeting is and what a good budget looks like. And then we're just going to try and bring it together with some practical tips to help you get started. And then, as I said, finish up with some questions. So, Alistair, why do we need a budget?
Good question, Brent. And in my mind, I think there's four real reasons on why budgeting is important, actually critical, I think, for any business looking to get ahead. And the first is that it links strategy and finance together. And so as business owners, we tend to spend quite a lot of time thinking about and planning our strategy. We have our strategy workshops and at the start of the year. But it can't happen in a vacuum. And so there's a planning loop, if you like, that we like to talk about. And so we have our strategic plan, and then we have our financial plan, which is what we're talking about today. And that really drives our tactical plan, which is what happens on the ground. And so without pulling them all together, we've only got half a plan, and half a plan isn't really a plan. And so what a budget does is it quantifies the strategy. And we need those numbers in order to properly plan the future, and in particular to make the proactive decisions that we need to make to tweak and improve the business. So that's the first point.
Yeah, and it's really about setting out those milestones so we know as quick as possible when we're getting on track or off track with the plan.
That's good. That's good. And so point number two is that a budget will give us the ability to learn from history. And history, as we know by definition, repeats itself. And in particular, bad history tends to repeat itself more often. And so going through the budgeting process allows us to understand what went right, what went wrong last year. It allows us to challenge the status quo rather than things just going on the way they have been. And budgeting is actually an evolution. So if we continue to work at the process, we will get better and better each year. And so we're learning from history, and then we're actually improving on that history.
That's right. And often the budgeting process, a great way to start is just to run through our wins and fails and learns from last year, which will give us a really good place to start and help get the thought process going.
That's good. Exactly right. Point number three, I think, is really the alignment piece around aligning management around that common goal. So if we think about finance as the common language of business, the budget process and the budget outputs allow us to align departments and managers around what those financial goals are for the year. It gives us something that we can link those parts of the business together and be governed by those numbers. And everybody then has got that common goal in relation to the specific performance outputs of the business.
Exactly. So rather than just flying around aimlessly, we've got the landing lights on, and we've got an airport to fly to.
That's exactly right. So that's 1, 2, and 3, and the final point is really about understanding the fundamentals. And so we talk about the benefits of budgeting being planning and process. And the actual planning, the budgeting process allows us to get a better understanding of the fundamental drivers within our business. So what does the core profit model look like? And then knowing that, the P&L model then drives the cash flow forecast. And what I like to say is that you get as much value out of the budgeting process as you do out of the actual financial plan itself. So that's really the four fundamental points, I think, on why budgeting is not only important, but it's absolutely critical in order to drive our businesses forward. So coming from there, Brent, can we perhaps look at what does a good budget look like?
Yeah, it's a good question. And before we get to it, I'd like to just have a quick discussion on what a bad budget looks like, because we do come across a few here and there. And firstly, it's not just a sales forecast. That's part of the picture, but it's not the whole picture. It's not last year plus 10%. Because there's this, obviously we want to be improving and adjusting our business model, and never taking the status quo for granted. It's not just optimistic and unachievable. So we need a touch of reality with that, with the budgeting. And it's not something that's totally uninspiring to everyone. No one cares about it, and it's not something that's sat in the bottom drawer for the last 5 to 6 months. So what are the fundamentals of a good budget?
So there's really 7 fundamentals that we like to talk about, isn't there, Brent? And the first, I think we've touched on it a little already in relation to learning from history. And so the critical element in you might say that the pre-work in planning your budget out is that we're looking at what's happened historically. Sure, we're not absolutely governed by what's happened historically, but the best predictor of what's going to happen in the future is what's happened in the past. So we're looking at what's happened. As you say, we're not just adding 10% to last year, but we understand what happened last year, why it happened, and we're learning from that, and we're improving. So we take the you might say the opportunity to understand what worked, what didn't work last year, what assumptions perhaps that we made in our budgets last year that were right, what assumptions were wrong. And as I said earlier, we're looking at that evolutionary process, so that every year as we do our budgets, we're improving and getting better. So we're learning from what's happened, and we're using that to improve the future.
Yeah, it's really an opportunity to sit back, stop, and reflect, and start to get a really deep understanding of where our future numbers are going to come from.
That's good. That's good. And so point number 2, and I think we touched on this earlier, but I think it makes sense to reiterate, is that our budget, fundamentally, it has to link with our strategy. So we've set our strategy at the start of the year. We've said, okay, this is the markets and the customers and the products we're looking to tackle. These are the strategic investments perhaps that we need to make, and we've set all these wonderful plans. But where the rubber hits the road is in the budget, and so the financial plan has to tie back to that strategic plan. If we've said that we're going to expand into this geographical area, or we're going to take on this new product line, we've said that in our strategy. Well, does our budget actually bear that out? And strategic investments, in particular, investments in people, in property, in equipment, maybe other items, you might say in the P&L, it has to link back to that strategic piece, so that the two of them work together to come up with a consolidated business plan.
Yeah, it's a good point. Now, the third fundamental with budgeting is they need to be realistic here. So they're not a fairy tale. They're something we don't want to uninspire the team, and so it all ends up in the too hard basket. So and it's going to be based on what is our most likely scenario. So as part of our planning process, and we may have multiple scenarios, but the budget is really once we've figured out what success looks like, we've locked it in, for the team moving forward to manage by.
That's good, and as you say, not overly optimistic. And so the key point there is that our revenue forecast in the budget, it doesn't need to be our top line sales target. In fact, it shouldn't be our top line sales target, because typically we'll set stretch targets for our sales team. But if we build our budget off the best case scenario, and then we don't perform at that level, well, we're behind the eight ball from day one, and then the budget gets very out of date and very irrelevant, within 1 or 2 months of the year being passed. So we have to make sure that the whole budget is set at the point or the scenario that is most likely to occur, not just the scenario that we want to occur.
Exactly. And that leads us on to our next point about building our revenue model. So, as you said, it's not our sales targets. It's more about what are our invoice sales going to be, or what's our recognised revenue going to be for each month. So it's not our sales orders in. And then it's a case of, once we've identified what our product mix is, the type of customers that we're going to be targeting, what suppliers we're going to be using and any changes there, what geographic location we're moving into, then we can start to get a good understanding of things like the costs that are attached to those different types of products and revenue stream. So it comes down to having a really good understanding of the relationship of our revenue and our GP, and getting our gross margin forecast right.
Yeah, that's good. That's good, Brandon. And you spoke about product mix, and it's something that we often see. You might say one of the pitfalls of forecasting is that we're making some assumptions, particularly on GP, based on history or historical numbers. But they've got to be brought up to date, but they have to tie into the revenue model. So if our product mix is changing, or some other element of our revenue model is changing, it's got the ability to impact the gross margins that we're going to achieve. And so having the revenue model in place allows us to understand what's going to flow through the GP line, and then from there down.
Exactly. And some of those changes require strategic investments, as we've touched on. Now the fifth fundamental we wanted to run through is just simply saving money. So reviewing last year's expenditure, and really challenging the status quo to make sure that we're not just taking things for granted and continuing on as before. And a really common one is subscriptions. They tend to build up over time, small amounts here and there, and it can often grow into something quite a large monthly item. So it's not about choking the business with cutting expenses, but ensuring that the business is resourced appropriately to achieve its targets. So we talked about the revenue model. So this is a start with the revenue model, and looking at what expenses are required to achieve those targets. But then also looking at your budget from the bottom up. So what net profit do we want, and what expenses are we already committed to? What fixed costs do we have? And ensuring that it's sustainable both ways.
Yeah, that's good. And the I guess zero-based budgeting is a bit of a buzzword for a lot of people, but it's absolutely necessary in a lot of our expense categories, because otherwise we tend to throw good money after bad in maintaining expenditure that we're not getting value out of. So you spoke about subscriptions. Marketing is another area that we can look at. Sometimes staff training. There'll be items on your P&L that, if you take the time to build that expense forecast from the ground up, from a zero base, rather than just taking what we did last year and increasing it, we will find some real opportunities to save costs, and then not just in overhead expenses, but then looking at above the line. So if we look at the ratio of costs that we've typically got above the line compared to below the line, it might be very difficult to cut out 0.5% or 1% or 2% of our sales in terms of overhead costs, compared to the ability to do that above the line. It's more difficult to identify above the line because it's all up there in cost of goods sold or direct costs. But if we take the time to examine that, and that may be negotiating with suppliers. It could be changing suppliers. It could be looking at efficiency gains. Maybe we'll get something in terms of volume. But we need to examine not just the overhead costs, but also what sits above the line, so that we can challenge those costs and find, okay, where can we find some improvement here?
Yeah, and obviously that's where time spent you get the greatest leverage on, because of the amount of dollars up there. And sometimes it can also be not just saving costs, but changing the nature of the cost too, from converting things from fixed to variable, particularly above the line as volume goes up or volume goes down. Because if we're forecasting a drop in volume, can we reduce our expenses fast enough?
Yeah, that's a good point. It's a good point. So the next fundamental, number 6, is in relation to being funded. And so we're speaking about taking through our P&L forecast to a conclusion through to the bottom line. And once we've got that clear, then we need to understand, are we going to be able to fund it? And so it's particularly relevant for any businesses that you might say are a bit cash strapped or a little tight, typically speaking, for cash. It's very relevant for businesses that are looking for substantial growth. Can we actually fund that growth? What are the funding requirements for the year ahead? If we're looking at growth, what are the working capital requirements? What do we need to forecast in terms of increase in stock holdings, in debtors? So what are those working capital requirements, and can we actually fund them from the profits of the business? And then further to that, do we need potentially external funding? What are our current funding commitments? Do we have any headroom? So we can build a very pretty picture in terms of the P&L, but then can we actually fund it? And so if we've got the P&L forecast, then we can take that forward and develop a balance sheet and a cash flow forecast from that point.
Yeah, so as I say, cash is king, and it's a overused term because it's true. And if you don't understand your working capital trends, I'd encourage you to find that out from your accountant as soon as possible, because trends when it comes to budgeting are very important to understand, in that, you know, are our debtor days going up? That is, are our customers paying faster or slower? What's our stock days? How much stock are we carrying for the level of volume that we've got now, as well as the level of volume that we're predicting to get? And are we thinking of ways to continually optimize that, as well as in our budget allowing for investments in working capital to achieve our objectives? If we're predicting significant growth, then we need to, you know, allow for that in advance in our working capital.
That's good, Brent. And as you say, the trend is your friend. So it's critical that we understand what those trends are. So finally, a good budget will always be kept alive. And so we can go to a lot of effort to prepare a budget for the year ahead. And as we said earlier, there's a great deal of benefit, not only in the output, but also just in the process itself, in going through that budgeting process. But if it stops there, then we've only got part of the benefit. So we need to keep the budget alive. It shouldn't just be buried in a drawer, or perhaps more relevant, buried in our hard drive somewhere, or on somebody's email. It should be kept alive. So that means that once the budget is complete, then the budget is uploaded to our accounting system. We've got the ability to report every month, whether that's internally, whether it's externally, but we've got the ability to report actual performance against budgeted performance. And then looking at those variations, we can not only explain the variations and why we are not performing, underperforming or overperforming against particular areas, but we can make decisions to either, capitalise on those trends or to reverse any poor performance.
Yes, and I like to say to business owners, budgeting is a way to scale up your management as well as your decision making. In that every month you don't need to review a detailed profit and loss line by line to know how you're going. You can just simply look at your three biggest variances from actuals to budget and get the big picture. So we just wanted to run through a quick example of what budgeting would look like. So first of all, the place to start is in your revenue work paper. So as we discussed, you need to nail down your revenue model. And so that includes things that we've said already, so your product mix and what that GP looks like.
Yeah, that's good, Brendan. And this is probably a pretty simple example, isn't it, of a revenue model. And many businesses would have a much more complicated model than this. But it's not enough just to say, okay, well, this is our sales targets for the year ahead, or even our invoice targets, month by month for the year ahead. We really need to understand what that revenue model is made up of. So what are the assumptions that sit behind it? Because when the performance falls short, we need to understand where did we fall short. So we can look at the variations and understand, okay, well, this is what we assumed would happen. This is what actually happened, and we can explain the difference. And then, as we said here, this is a relatively simple, sales breakdown or revenue breakdown. Other businesses would have more complicated ones that require more work, but that shouldn't discourage us. So there might be businesses that have got quite a project-based business, for instance, quite a long lead time or lag between a sales order and an invoice sale or some recognised revenue. Could be 3 or 4 months. And we need to understand the relationship between what our sales targets are and what we expect, to land in terms of invoices, orders, and then when that translates to actual revenue on the P&L. And so this is not an area to shortchange in the budget process. We need to spend some time on making sure that we understand our revenue model. It makes sense. The assumptions are as good as we can get them, and then that flows through to what our revenue is on the forecast each and every month.
Yeah, and we've also got in here just the 2020 numbers just to check, how realistic they are as well. The next work paper we want to discuss is the HR. So typically here, we'd recommend always starting with a zero-based budget for your HR. So we've got a good idea of what's in there. And also, once again, ensuring that the business is resourced effectively. So we might decide as part of our additional revenue that we expect to get that we're going to need some extra staff to support it.
Yeah, that's good. That's good. And as you say, it has to be zero-based budget here. We can't just take, what our wages were last year and add some new employees on. There's so many variations. It's typically speaking our biggest cost, certainly our biggest overhead cost, and it has to be built from the ground up. But then, as you say, any strategic investments in people or in staff, any timing differences, somebody comes on halfway through the year, we need to account for that. We need to account for what those on costs are, superannuation, obviously coming up 0.5% this year. We've got payroll tax and so on. So our HR model, from a budgeting perspective, needs to all tie together, and we need to spend time because on getting this right, because it's an area that is a pretty big monthly expense, and it can throw our budget out very quickly if we don't get it right.
Yes, and this is as you said before, it is a fairly basic example. Often this component will be pulling together a full people plan for the year. Correct. Now the other one is obviously just your general expenses. So we've started out here with just an example for a heading of marketing costs, and what costs we expect to incur over the year. So, and this is really looking at what resources do we need to achieve the results that we want. So if we're expecting increased sales, then for some businesses that may mean more marketing costs initially. So this is where we're really starting to look at what the drivers are of the results that we want to achieve.
Yeah, it's good, Brandon. And it's also an area to put down the assumptions. So we speak about assumptions quite a bit in budgeting. But if we don't actually have something to back up a budget, some workings and some assumptions to back up a budget, well, when we don't perform against that budget, or there's significant variations against that budget, then what we find is we can't actually explain why the numbers are different to what we expected them to be. So when we look at the P&L, we've got to make a decision against all those line items. Which ones should be a zero-based budget? That is, we're building it from the ground up, as we are here with marketing costs. Maybe there's some other method of calculation, but we have to build those assumptions in there. And there'll be items in there which are, for instance, bank charges. Well, we're not going to spend a lot of time on that. So there'll be items that we can throw a number against. Others we really should spend the time to get the work papers in, get the assumptions right, and build that from the ground up.
That's good. So that's your P&L. Now, once we've got our P&L correct, that really feeds into our cash flow. Now, this cash flow isn't necessarily a management tool that you would manage by day to day. This is just about ensuring that your budget that you've set is sustainable. And so I was looking at things like, when will your customers pay? When do you need to pay your suppliers, and what terms do you have? How much stock are you carrying? And then also, what investments need to make too? Are we going to buy some capital equipment? Maybe there's a scenario where we're going to outsource some manufacturing. So this is just about building a picture of what success look like. But then as Alistair said, once we've put this together and we're happy with how it looks, then it's just a case of uploading our P&L budget into our system and using that for the day-to-day management of the budget.
Yeah, that's good, Brent. So we talk a lot about three-way forecasting, don't we? And so that is that the P&L budget, or the income statement forecast, drives the balance sheet forecast, which drives the cash flow forecast. And so getting the P&L right first up allows us to have a look at what the impacts are on the balance sheet in terms of the key drivers on the balance sheet. That then flows into the cash flow statement, or the cash flow forecast, and we can really understand, not only what are those working capital requirements and the impact that's going to have on our funding requirements, but what are the other key movers in relation to capital investment, as you said, and the other items, money in and out of the business.
That's good. All right. We'll just wrap things up just with just to summarise what we've been through. Do you want to go through the key takeaways, Alistair?
Yeah, so I guess we spoke about the key reasons on why we need a budget, and the four points that we gave were relating to linking strategy with finance. So understanding that half a plan is not really a plan, and we need to really pull those two together. Secondly, we spoke about learning from history and the ability to find improvements and savings, and just evolving that process on the way through. We spoke about aligning management around that common language of finance and the common goal. We spoke about understanding the fundamentals of what our P&L and our profit drivers look like. From there, we spoke about, particularly about what isn't a good budget, but then the 7 fundamentals of what a good budget looks like. And they are, as we said, learning from history, linking that budget with our strategy, being realistic and not optimistic, having that revenue model in place to drive through to the bottom line, taking the opportunity to find savings in our P&L model, making sure that it's fully funded, and then finally, but most importantly, keeping that budget alive.
That's good.
So finally, how does it all come together? we went through a pretty basic tool that we've got. We can use Excel, we can use some forecasting software. To some extent, it doesn't matter what you use in your business. The key thing is that you've got a tool that is workable, and that we apply you might say, the fundamentals that we spoke about to come up with that workable plan, that workable, you might say, profit plan, which is the financial forecast for the year ahead.
Yeah, so just about review and in that constant process of reviewing what's happened throughout the year. So we've had a few questions come through. Now, if there's any others, we'd really like to hear them and address them now. So I'll just quickly go through a few now. Now, we've had a number of questions around a budget template. So we will be sharing one after this webinar, along with a recording. It'll just be in a spreadsheet that anyone will be able to use, along with some, along with the recording. Now, I've got another question here. So how far would you break down your expense lines? For instance, cost of goods sold, breaking up direct labour per department, supplier, production, etc.
Yeah, that's a good question. I guess my answer to that would be, we don't want paralysis by analysis. So we break it down enough to get an understanding of what makes up our expense forecast and what makes up, you might say, the outcome. All right, but there's no point in breaking it up or breaking it down to the point where it becomes unwieldy or unmanageable in terms of the ongoing reporting. So from a forecasting perspective, particularly above the line, and we spoke about this earlier, our expenses, our overhead costs below the line are relatively easy to forecast. Above the line, it gets a little more difficult, and so we generally revert back to taking some percentages and for anything in cost of goods sold, and then we're looking at our fixed costs below that. What I'll probably an overriding point I think that I would say in summary is that for above the line forecasting, only break down your cost of goods sold if it makes sense and you can get the detail to do it. Otherwise, we do get paralysis by analysis, and just a simple percentage is probably good enough. But when it comes to direct costs, absolutely, you need to break those down, particularly where they're fixed. Break those down and understand what is sitting in there in that direct expenses forecast for the year.
It's a good way of looking at it, and I really like the nimble side of it too, because we don't want to make it too big and scary for people to do. So as far as the budgeting process and how detailed it should be, who should be responsible for the budgeting process as far as preparing it and reviewing it and keeping it on track?
Well, I think it's good to have more than one person involved. So most people don't like budgeting, and so often it gets left to whoever wears the finance hat in the business, whether it's the CFO or the finance director or sometimes the bookkeeper, depending on the scale of your business. But it's good to get more people involved, and so as we said, finance is the common language of business, and in order to keep people accountable, they need to be accountable for what relates to their area of the business. And so, I mean, an obvious one, for instance, is the marketing budget. We pull the marketing budget out and we hive that off to the marketing team, and there's some back and forwards, and we get that right, and there's some agreement on that. But generally speaking, you can take a combination of line items, even if it's just to break down the workload of the budgeting process. Take a combination of line items and distribute them between some people, perhaps even on the management team, and say, let's work at this together.
That's good. All right, see if there's any more. So how detailed should the budgeting process be, and how much time should we be spending on it?
Well, I think if we can take one thing out of the webinar today, I think is that the more you put into this process, the more you will get out of it. And so, you know, it's a bit like the old Nutrigrain commercial. But we spoke about paralysis by analysis. So you don't want to go perhaps to the extreme of that point, because there comes a point where you get, the law of diminishing returns kicks in. And if we take, 6 months to prepare our budget for next year, we're probably spending a little bit long on it. That might be an understatement. But I think the point is, put enough effort in to make sure that we understand what the key drivers are, put enough effort in to get the real benefit out of it in terms of getting the forecast nailed, achieving the cost savings that we can, and understanding, where those variances are in terms of managing the budget on an ongoing basis.
Yeah, so we should be getting the forecast, our budgets drafted up now and starting to get approved. Yeah, so they're all ready to go by 30 June. Now I've got another question here. So any advice for what to do if 10% growth always seems to be more accurate than a detailed breakdown?
Yeah, so I assume that we're working on we're talking just about
yeah, so to give some context, we've got in the question here, consumable sales business with hundreds of customers.
Yeah, so I'm guessing that's in respect of the sales forecast, 10% growth on the sales forecast. I think that just comes back to a revenue model, and some are more predictable than others, and so a detailed breakdown might not be the answer. The question is how can we get the most accurate prediction of what the future will be? If the answer is, well, we're going to pick a 10% growth number for the year, well, that's the answer. We just stick with that. But the point is that we've got some assumptions behind that, and that we know how we manage against it.
Yeah, and in my experience, that there's always a way of I guess filtering out those assumptions. So rather than just going broad brush, it might be by a industry segment, it might be by a geographic area, or it could be by a particular bundle of products. It's really just to make the decision making easier. Got another one. Do you have any suggestions in the current climate of constant and even unpredictable material increases such as steel, and how to keep pace with price increases?
Yeah, that's a good point. And I think what I would say is that the current climate points up even more the importance of forecasting. And so you might say at face value, well, the 12-month forecast is going to be out of date in 3 months. Well, perhaps, yes, perhaps it will be. But we've then got the opportunity to review it and update it if required. But going through the budgeting process, sure, we can't see 12 months ahead. We've got clients obviously that deal a lot in raw materials with steel and timber, going through some immense price increases, very volatile at the moment. What we would recommend is that we say, okay, well, we work on some assumptions now, and we review them on a regular basis. And so that might be on a quarterly basis. Some businesses may be having to review on a monthly basis at the moment. But it shouldn't stop us from going through that forecasting process.
Yeah, and I think that's where scenarios start to become very powerful as well, in that we're stress testing and we know where our limits are on these changes that come through.
Yeah, just one final point on that I would say is that there's price increases coming through from suppliers, but we're also passing our own price rises on to our customers, and so our COGS perhaps are going up. We need to allow for our sales to go up as well.
Yeah, that's good. So another one is a financial year or calendar year budget better to work to?
It's a good question. It's one that comes up a bit, and I think it's probably in the context of a lot of businesses tend to run strategic planning on a calendar year basis. And I would say if you find a disconnect between your strategic planning and your financial planning. One might be on a calendar year and one on a financial year. I think that may, if it makes sense, I wouldn't have any problem with doing forecasting on a calendar year basis. However, we would always recommend a 6-month review of your budget anyhow. And so ideally what we'd like to see is that we've got a 12-month budget, and then at the 6-month mark that gets reviewed, and then we stretch it out for another 6 months anyhow. So you've, to some extent, you've still got that you've still got that 12-month budget in front of you.
Yep, it's good. Now it's got one final one. So for a sales budget, and I assume this is around our revenue model, should we be looking at a breakdown per unit and then convert to dollars rather than just going to dollar figures?
Yeah, it's a good question. It would probably depend on what makes sense for an individual business. However, I would tend to favour that approach. And that could be a business that sells widgets for $100, could be a business that sells shed projects or fit out projects at $300,000 or $500,000 a pop. I think we'd have to understand, you might say, the unit economics of our sales forecast, and then perhaps bring that back to dollars. Actually helps us, particularly in the context of okay, so I'll take the example. For instance, I was going through a budget just in the last week with a shed builder, and so the budget started with a volume of product, and then was converted to dollars. And a real reason for that is that there's been substantial price increases being passed through to the customer. And so if we just went off the sales number, we'd actually be undercutting or underselling what those revenue targets should be.
Yeah, and as we said earlier, it's so important to understand the drivers behind each number, because at the end of the day, the sales figure is just a result. It doesn't show the inputs that went into that, and they're not all dollar figures. They're tons, they're kilograms, they're centimeters, or whatever it might be.
That's good. That's good. We may need to wrap it up there. If there's any further questions, feel free to pop them on the email, drop us a line anytime. We'd be happy to answer them. Other than that, we will leave it there for today, and we will hopefully see you again next time.
It's good. So there'll be a short feedback when you exit. So I just want to thank everyone for their time, and if it seems like too big of a task for anyone to do, I'd be really glad to hear why and have a look at where the challenge is coming in. So please reach out to us if you have any issues. Thank you very much.
Thank you.